Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Chris Engelbert, Founding Partner and Chief Investment Officer of Engelbert Financial Advisors, to discuss how RIA firms will fare in a return to normal world and managing client expectations along the way. And Chris, time flies. Happy New Year. It's great to see you again. Welcome back to Trade Talks.
Yeah, great to see you again too, Jill. It's really gratifying to have the clock turn from 2020 to finally 2021.
Right. And we just went through the administration transition this week, and it just feels like the clock has been resetting, as you said. And speaking of that, how are you communicating to clients what the investment and economic environment will look like as we work to get to the other side of COVID-19? Because it's not just a switch that you flip. There is going to be some work to get us there.
Yes, Jill, there will. But my real theme for 2021 is what I call the return to normal. And it's in a couple of different areas. So obviously the coronavirus vaccine is rolling out, more and more rolling out literally every day, every week, every month. So at some point, we're going to be getting on the other side of this, whether it's, early or late spring. And what we're trying to tell our clients is that you got to be prepared. We think that clients are going to be very surprised by how quickly some particular situations return to normal. I mean, we're seeing, pickup in airline travel. We're seeing a pickup in travel in general. People are getting out. So things are happening a lot more quickly, and we think it'll only accelerate. The other thing that we want to talk about as far as a return to normal is as far as the economic numbers out there. So last year was unprecedented. We never shut down our economy, never, partially reopened it. We saw some crazy employment numbers as massive employment, people were laid off. And then as businesses began opening back up, you saw some crazy GDP numbers as well. GDP falling off a cliff only to rebound sharply. And so when I say 2021 is a return to normal, we're actually thinking that there's going to be some pretty boring numbers coming out. We continue to see an uptick as far as employment goes. And we think that's obviously good, but we're not going to see those giant swings one way or another in these economic numbers. And it'll be fun 10, 15, 20 years from now to look back and say, wow, look at that blip on the chart.
2020 was just a big, giant anthropological study in and of itself. But I think when you are looking at the numbers, when you're comping, right, in theory, we should comp much better than we did in 2020. So it's almost like, do you comp to 2019 numbers if you're thinking about that new normal? I think we have to put things into perspective and relativity too.
Yeah, I think a lot of people, especially in my profession, that's what we're looking at, okay, 2020 was an abnormal year. Let's draw our trend lines off of 16, 17, 18, 19, kind of exclude 2020 and see how 2021 shapes up as far as the recovery goes, because we still have extremely low energy prices, which we'll talk about in a minute, low interest rates. And again, the economy is opening up, improving, and we're going to get on the other side of this thing. And again, a lot sooner than what we think people will realize.
Let's talk about what the RIA practice is going to look like. Clearly, you had a pivot just like every other industry. Do you think it's going to be a hybrid of the two? Perhaps you won't have as many in-client meetings, maybe more frequent with virtual meetings, or do you think you go all the way back to in-person? How do you think RIAs are going to manage this?
Well, I'm going to coin a phrase. I'm coming up with it, so I'm coining it, called celebrity shock. So what I mean by that is that we've pivoted and we've gone 100% Zoom meetings, and some of our new clients that we've gotten over Zoom, we've never met with in person. So when I say celebrity shock, if there's a celebrity that you really like and you follow, and all of a sudden you see them one day at the mall or walking down a street, you're like, wow, look at that person, and you finally get to meet them. And I think there's going to be a lot of celebrity shock where, RIAs, when we have people come into our office, they're like, hey, I'm seeing you in 3-dimension, not 2-dimension. But I do think the hybrid is here to stay. And the reason I say that is that it's a much more efficient way that what we found in our practice. We have a lot of high net worth clients that work all day. At night, I'm in the office 5:30, 6 o'clock, and it's very easy to dial a Zoom meeting up. They don't have to drive, 45 minutes, sit for an hour, and then do another. And also from an institutional standpoint, I'm finding it very effective. I had a Zoom meeting with a small municipality where I could do some education for about 45 minutes, and it was much better over Zoom than it would have been in person, because again, I didn't have to drive an hour and you had this whole meeting. So I really think this is broken through to give us that hybrid, which I think is going to be literally the wave of the future. I think the other thing that 2020 really demonstrated to the average investor was the value of a registered investment advisor and the strategy that we had. And you and I talked about this all, year last year. Don't panic in February and March. We pushed money back on the table. We had a recovery. There was a lot of people panicking pre-election. And we were able to keep them calmed down. And sure enough, we've had a wonderful finish to the year end and the start of the new year. So I'm looking forward for great things as far as this new hybrid scenario. And I think it's here to stay.
Yeah, Kristen, I want to follow up from the consumer perspective about what you said with Zoom meetings. As someone who's in grad school, go Rutgers Knights, I had to throw that in there, represent for the Big Ten, Chris, but you don't have the stress of, okay, I have to get the train out of the city, get myself to New Brunswick, or leave my house and drive over to campus. The transition is much easier when you do school from 6 to 9, from flipping off one switch at work and flipping on the personal laptop. You don't have the stress of that. So I would agree with you. I think people who are working full time or they have, managing families full time appreciate the flexibility that, having the choice of virtual gives you. So I agree with you there. Let's take a look at our charts. Let's start with the S&P 500.
Yeah, S&P 500, we kick off the year with new highs. Again, now this is my theme on return to normal. You got to remember, we've had a massive rally in November, December, and we've capped off the first 2.5, 3 weeks in January with a follow through. So last year was unprecedented. One of the sharpest declines we've ever had, one of the nicest rallies to new all-time highs we've ever had. It was very abnormal not to have a normal, back and forth in the market. And so what I'm saying in the return to normal in 2021, right now the markets are stretched, our risk indicators are elevated. I would not be surprised that, maybe February, March, the markets cool off a little bit, but we have not had a correction of greater than 10%, obviously since last February, March. But the point being, in a normal stock market, it is not unusual to get 1 or 2 10 to 15% corrections per year. Now, we don't think that's going to be a bad thing this year, but we're just trying to set people's expectations and have them understand that, we think that 2021 is going to be a more normal stock market.
And the Nasdaq 100, of course, outperforming 2020 pretty significantly.
Yeah, a huge outperformer there. And the whole debate, large cap growth versus large cap value. The last couple of weeks, we've seen a very vicious rotation into the value stocks. Now, one of the points that I want to make about that is that, this may be a little bit different when people are talking about value. And I'm very hep on this idea that technology is now permeating every area. It's not just the large cap tech stocks, software as a service, et cetera. You got to understand that a lot of the value stocks, i.e. the banking industry, the energy industry, they're using technology now too. So it's like when computers first came out, only math departments had computers way back in the day. And then all of a sudden business discovered that you could use computers for everything else. The same thing's happening. And that's why we think you're seeing this, transition that, value companies and value, areas are really embracing the new big data technology, and it's going right to their bottom line. So, we think maybe the Nasdaq might cool off a little bit and the baton gets handed off. But it's going to be good all the way around, i.e. for technology.
And the Russell 2000, I think this is the first time that we've kicked off a new year together where we've actually seen some participation.
Yeah, and I can't reiterate enough that people should watch, what you and I do. We mentioned this back in November. You and I were talking about the Russell 2000, and both you and I talked about how it's been lagging, and that really what's going to happen is in any type of recovery, the Russell 2000 could not only catch up, but 2021 could be the year of the Russell 2000. Look at what's happened. It's literally gone vertical. Again, it'll probably cool off, but it's one of those areas that it's performed really well. And you and I talked about it literally 3 months ago.
All right. In our last couple of charts here, we typically look at monthly charts, but you're looking at weekly in oil. It's had quite the rebound.
Yeah. So oil got real hot. The oil stocks have, exploded this year. It's one of the best performing sectors out there, but I wanted to throw in the weekly chart. Because the weekly chart shows you that there's still a very long-term downtrend line on oil. So I'm not saying that, oil has a huge pullback or anything else, but, 2021, there's still a lot of work to be done before oil turns around and makes a significant, a turn, more of an intermediate term. So we've had a really nice rally, but we've seen these really nice rallies the last couple of years only to fail and go to new lows. I don't think we're going to go to new lows on oil unless obviously something happens globally. But, I'm trying to temper people and say, okay, 2021 could be the year that we finally break out, but maybe the latter half of the year.
And finally, let's wrap with the weekly chart on a 10-year. And Chris, I think part of the story too has been the velocity of the move that we've seen in the 10-year.
Yeah, so I show a weekly chart again now. I'm very much more concerned about interest rates than I am, about equity markets, because you can see the low base that we're at off. And I wanted to show the weekly chart because it was only literally 18 months ago that the 10-year Treasury was over 3%. So you've now seen we've broken over 1%. One of the theses that we're talking to clients about this year is that there's a return to inflation, not huge inflation, but compared to the last couple of years, 2.5%, 3% annual inflation, that doesn't bode well for bonds in 2021. And we think the 10-year is starting to sniff that out. So I do believe rates stay rather muted for the first half of the year, but when it looks like the economy is really kicking in again, you could see rates higher by the back half of the year. So it's something that obviously we're watching very closely.
All right, Chris, great stuff. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.